Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week, as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, April 5th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right, well, last week, the NASDAQ and the S&P 500 were able to finish higher for a third straight week. The Dow Jones couldn't quite keep up pace. It was down less than a 0.1%, but basically we had a lot of back and forth trading. They weren't able to make much progress. We've had two real solid weeks, and just as March was ending, we saw the major averages tumble into April. They had a rough go of it there, but on Monday we started out led by about 8% spike in Tesla after they announced the stock split. And then we also had a 9% drop in oil prices as we to start the week. The people were kind of hoping that we're going to get some progress in peace talks with between Ukraine and Russia. Obviously, that didn't happen, and now we've been seeing oil prices tick up ever since that fall back. And again, I think they're up today. We're back up around 105 today. They dropped down into around the 90 level, 94 level, somewhere around that. So. That gave stocks a little kick across the board. And then as Tuesday was going on, we started out a little bit higher. And the S&P 500 and NASDAQ had basically recouped all of the losses since the Ukraine invasion had taken place. That started back there in February. So it looked like, possibly we could turn this thing around and maybe at least try to get to new highs. That failed to happen again. We saw, the peace talks kind of broke apart. Then we saw some the interest rates move higher on some inflationary data that we got again. We had the Personal Consumption Expenditure Index. That's the PCE. And that's kind of what the heavyweight for the Federal Reserve. That's what they base a lot of their action on. And it showed that we were up about 6% year over year in that index, and that's again too much inflation for the Fed. They're going to be all over that. So that kind of took the wind out of the sails. We kind of drifted lower into the weekend. And it's important to note that the sectors that were strong last week, the market really has taken a more of a defensive positioning. We had REITs, utilities, consumer staples, and healthcare. They outperformed the market. And then despite rates going up, we're still getting this flattening of the curve and at times an inverted yield curve, which hurts the banking stocks because they like to make their money with the spread there. But we had financials, energy, and industrials were some of the weaker sectors last week. And that's the fact that the defensive sectors are outperforming is a little bit is very telling in here, because a lot of times in a rising interest rate environment, you will see some of these defensive stocks actually not do very well either, because people will buy them for yields. But in this case, they're expecting those companies to show a little bit better earnings guidance as we go forward. We're starting to see a pullback in consumer spending. That's not good for the XLRE, the consumer discretionary sector. It's not good for the tech sector either. The consumer still drives a big part of the economy, and if they start to cut back because of higher prices, that's going to lead to more trimming and earnings going forward toward the end of the year. I think Morgan Stanley is towards the fourth quarter. They're almost getting down to flat now. So that's something to be a little bit concerned about. The other thing is that I think on Thursday or Friday, we actually did have the yield curve invert. That's when the 2-year Treasury pays more than the 10-year Treasury. So, that's again is troubling to a lot of investors. You always will have every recession has had that happen before within a year or so before we go into the recession. However, it doesn't always lead to that. I mean, there can be things where things happen that it doesn't necessarily mean you're guaranteed to go into recession, but it is a red flag that there certainly can lead to it, and every recession has been preceded by an inverted yield curve over the last 100 years, 50 years or something like that. So we got to keep that in mind. Again, we had another thing that led to lower oil prices last week was the fact that the White House and now several European countries have released some of their oil reserves to counter the high prices at the pump. Doesn't seem to be having that much of an effect, but that actually is one of the reasons, because that takes a little while to get back out into the system. It's not like they snap their fingers and all of a sudden they have all this oil that's coming out of the market that's going to lower prices. So, maybe that'll help cap the price we pay for gasoline at the pumps, but we'll have to see how that goes. So, like I say, at the end of the week, we had the S&P 500, NASDAQ were higher for a third week. Not a lot. I mean, the S&P 500 only picked up 2.8 points last week, but it still goes in the win column. The NASDAQ was up 92 points, and the small cap Russell 2000 was also up a little bit. So the technical condition of the market did deteriorate some last week. Part of that is we had basically all of major averages except for the S&P 500 and transports had fallen back below the 200-day moving average. That's a negative. The Dow slipped below that on Thursday on their sell-off. And another thing to note, and we can look at the charts here in a little bit, is that the NASDAQ and the Russell 2000, both of them had stalled right at their they did come up to the 100-day moving average, which was below their 200-day. Then these are key, moving average support resistance lines, and they couldn't get above it. Yesterday's rally in the NASDAQ, we were up 2%. Again, it came right up to the 100% or 100-day moving average. Could not push through that resistance level, and of course, then today we're getting that pull back again, and we pretty much, as we're speaking, the NASDAQ's down 2.04%, so that's given back all the gains from yesterday. And the Dow, as we speak, it's down 150 right now, so it's given up all of yesterday's gain plus another 50 points. So falling back below some of these key averages that we'll look at again. The transports and the Philadelphia Semiconductor Index both suffered heavy losses on Friday. It sent them below some of their key averages. The transports were looking good up until that point. They had actually retraced the first index to actually retrace all the sell-off from the Russian invasion, but it dropped below the 50 and the 100-day moving average on Friday, as did the semiconductor index, and both of them are getting hit pretty hard today again. I do want to look at the semiconductor index here in a little bit. It's down something like 3% right now. Transports are down another 2.25%. So it's another rough day for the transports. A lot of that is some of this is due to the trucking industry has been hit hard because of the higher fuel costs, and also the FedEx, UPS, the delivery systems. They're also having to battle the costs of fuel to get their products out there. We did see, as far as momentum goes, the momentum was slowing down on both indexes. That's a negative, or all the indexes. That's kind of a negative. It's the 14-day RSI has fallen down into neutral ground. We were at about 55 or so. I think we got up a little bit yesterday, and we talked about that we would like to see these indexes, the 14-day RSI, get above 60. Like maybe get 62, 63, 64, and stay up there for a little bit, and actually go, try to work their way towards 70 That was some of Connie Brown's work on the indicators, and she, we say that's probably you'll get that when you do have a change in the major trend, and these things got up right up to that 60 level basically, and have turned around and started heading south again. So her work is in line again with if we're going to have, if this is just a rally in a bear market, possibly that was about as far as we're going to get, and we'll have to see over the next couple of days whether that's going to hold up again. The advanced decline lines, which we look at as leading indicators of market direction, they were basically flat last week. I think the NYSE advanced decline gained about 1,800 units. The NASDAQ AD line, despite being up for a third week, only added 57 units last week. So that means you have just as many stocks going up as going down, which is that's about as neutral as you're going to get. One good sign was that investor sentiment has now fallen back down to neutral. We had reached extreme bearishness levels, back in March, but we finally had an uptick in the bears or in the bulls on the retail side. The American Association of Individual Investors actually had the bulls topping the bears for the first time since the last week of December. So for the retail investors, they've been more bearish all year long here. They're just starting to come around. Like a lot of times, technicians will look at some of these things as contrarian indicators, and in this case, we'll see what happens. But as the retailers start coming back into the market, we may have reached a little bit of a top here. We'll see. But as far as the pros go, we actually saw the percentage of bullish investment advisors top the bearish advisors for the first time since February. Now these are the guys that are recommending stocks and writing newsletters. So they've been overly bearish for a while, and they're starting to come around again, but they're still kind of neutral as far as where they go. But we are starting to see a little bit of a crossover on that. Now, one of the things I wrote about on Friday was that the market had been oversold. We had gotten down to about minus 6.97% at the end of February. And then at the end of last week, I think Thursday or Wednesday, we got up to a 6.69% at the top side to be overbought. And it looks to me like we're going back and forth in this little bit of a range here. And I wrote that between the Fed's rising rate cycle to get this battle on inflation, and then we have we have an unknown outcome in the Russian invasion. Investors need to step lightly in here because anything can happen. We can have some things blow up today. One of the things that caused the market to sell off today was Fed Governor Lyle Brainerd came out today, and she said that the Federal Reserve they're going to move more rapidly and as early as May to take down to start reducing the balance sheet. And she wants this they want tighter policy as fast as they can to make policy more neutral. That really kind of clipped the wings on the market today because they were starting to feel like, okay, well maybe we're going to go quarter point, maybe we get a half a point this time. We'll see how the data comes in. The next FOMC meeting isn't going to be until May, so so I thought maybe we get a little bit of we get 4 or 5 weeks in here. We can see how the data comes in to see if maybe inflation is going to start to come down. But that's not, but they're talking about that they want to keep everything, move as fast as they can. That's not going to be good for the market. And again, especially when you start having these rates going up, that hurts growth stocks as it makes forward guidance and the outlook's a little bit harder to project. So we'll see how that goes. Also today, another thing that's kind of psychologically moving the market, we had the 30-year mortgage rate went above 5%. That's for the first time since 2013. So that's going to make a little bit of that's probably going to hit the housing market a little bit, at least slow it down some more. And again, part of that is consumer spending. That's going to cut down on some of that also. So a lot of headwinds still in this market, and I kind of think we're going to be going going to stay range bound here, like I talked about on that. As far as the S&P 500, the reason these are important, I think on the downside we could be looking at maybe 4,200, 4,250. Upside would be 4,600. If these upside resistance levels can be taken out with good volume, then of course that would be kind of a bell to say, okay, we're not going to be range bound. We are going to make some new highs. The Dow, I think it can probably trade between like 33,000 on the downside, maybe around 35,250 or so, maybe 35,300, and it's got to get up above that. But we want to also see these top of the range taken out on increasing volume. I've talked the last 2 weeks that volume just is not there. It's in fact, what was I think actually a week ago Monday we actually had one of the lowest volume days we've had all year. Even yesterday's big jump up was that in the NASDAQ. NASDAQ was up 2%, but it was way off. It was 500 million shares less than it had traded the previous Monday. So we're not getting the push to the confirmation of volume that you want to see when you're getting there new highs and looking like they're going to break out. In fact, as you get closer to these breakout levels of the upside and you start to see the volume start to shrink, that basically is telling you that the big players are saying, or if anything, they're thinking about taking some money off the table at that point. So mixed market. I think we're going to stay like that for a little bit, and that's I'm just going to be neutral on the thing right now. The market posture is bullish due to where the CTI cycles are going, but I just think as far as trading and buying stocks, I would look maybe to add to some of the positions down by these low range totals that we have, and then maybe lighten up on some of the when we get near the tops. But of course the wild card is if something comes out and says Russia says, okay, we're going to have a ceasefire and stuff like that, you might see this market go up 700 or 800 points in a day. Who knows? That's the wild card. But as long as that's not happening, then I think we're going to be range bound with investors just watching the Fed and see how fast they're going to be moving rates up.
Okay, well, we appear to have another volatile week on our hands. The tech-heavy NASDAQ jumped almost 2% on Monday, and we're back down almost 2% today. Growth sectors led the major averages higher yesterday, and today they're the weak sectors. Does this play into your belief that we're in a trading range or range-bound market?
Yeah, almost exactly. Okay, number one, let's go to go ahead and go to the charts for a little bit. Okay, let me grab mine over here too. Okay, let's go ahead and pull up the S&P 500. Okay, get mine up over here so I can see a little bit better. Okay, like I said, if you can draw a line, you can see where we got up to on the S&P 500. We got close to the where is this here? Wait a minute. Hey, hold on. Okay. Okay, you can see here on the S&P 500, we came back up last, on Tuesday or whatever it was, and we actually had pretty much retraced all of the down movement caused from the war, not from the first of the year, but from the Russian invasion, and that pretty much is going to, if you draw a line across there where we reached, it's 4640. Okay, we need to take that out. That 4600, I think, is pretty much anywhere from there. If you draw that line across there, you can see that 4603 was where we kind of topped out 4600 right back there in twice in February 2nd, and again around February 10th. Okay, if we can cross above that on big volume, that's going to be a big plus, because as I talked about that, we reached above that on Tuesday, we were unable to hold it last week, but it was on light volume. That's something that we want to see that break above that on big volume. So right now we came up to here, and now we're back down. Today we're down like 50 points. We're back down at 40, 45, 46. So again, we're 60 points, about almost 2%, 1.5% off of those numbers now. If we start to pull back, I think you're probably looking down here around 42.75, maybe. That would be the low end, where you can see where we kind of bottomed out back there on January 28th, and we bumped up against that a couple times. That's probably about as low as you're going to go. And that line also, you can go back, and actually is where you kind of bottomed out in October. Raise the line up to there also. If you raise it across from that, you can see that October lows on the S&P 500, that was also provided pretty much support in at the end of January. And then we broke below it, came back above it, struggled with the 200-day moving average, came back down there and hit it a couple of times, and we finally broke through. But now we're coming back down to kind of test this thing to see how this is going to work out. Now, one good thing is we're starting to see an upturn in the 50-day moving average, which will be a big plus if we can get that crossing back above the regular 200-day moving average, not the EMA, but the SMA. That would be a big plus. Go ahead and I want to take a look at a couple of the sectors while we have this up. Let's go ahead and, when we talked about that we're seeing the defensive sectors lead the market, which is not what you normally are going to get when a market's getting ready to make new highs. Let's go ahead and take a look at XLE. In this case, it's kind of a little bit of a defensive sector, but it's being caused mainly because of the oil, and you can see that. Okay, so here we have a sector that's walking up the 21-day moving average, and we're almost at a new high. So of course that's all due to the sanctions and due to the price of oil, and that's not going to go away anytime soon. I don't think you're going to see some amazing profits in stocks like Apache and Fang and the Chevron, Exxon. You're going to make even though you're tempted, they're up 40, 50% year to date. You may be tempted to take some profits, but I think if you're not just a quick trader, I think you can hang on to these stocks and ride them for a while longer, because the profits on those stocks are going to be amazing coming out here over the next couple of quarters. But anyway, so you have energy here that's almost at a new high. You go up there again and just take a look at XLU, and that's the utilities. Again, here as bad as the market is, here you have a sector that's making new highs. I'm not sure what it's doing today, but again, the defensive sectors, you want to be in that when there's a lot of uncertainties going on, and growth's not happening, growth's kind of going back. The utilities are going to be fairly steady as far as their earnings go. Another one here is the XLP, which is another defensive sector, and we have that at not quite at a new high, but close to it. And these are kind of the in this sector, you have the stocks that people are going to need. They know Kimberly-Clark, the Colgate-Palmolive, they're all the stuff that you're going to have to buy no matter what. Doesn't matter, if interest rates go up 2 more percent, you're still going to have to buy toothpaste and toilet paper and paper towels and all that kind of stuff. So XLP is one that you could probably, if you have some stuff in there, hold on to it here for another couple of months to watch how some of these the rate cycle issues go and how the war goes. That's going to be an area that people are just going to buy. XLRE, real estate. Some of these trusts, they're still doing well. It's not making a new high, but this is a little bit more rate sensitive, and I think you may see the REITs struggle a little bit more in here. They're defensive because real estate is a little bit of a hedge against inflation, but I think people usually buy the real estate investment trusts as a for the dividend, and I don't think I think that that's fine, but when you don't want to be owning preferred stocks and bonds, that type of thing, and bond funds or that type of equity or stock when you're having rising rates. So I wouldn't be buying the REITs in here, but I certainly am not going to sell them because I think as far they're probably a better hedge than some of the growth stocks that are going on in here. Now another sector that you can look at that is kind of considered defensive would be the healthcare, XLV. And if we put that up again, we're not quite at a new high, but we're close. You're starting to see some of the biotech stocks that are moving a little bit higher. People are looking for a little bit more speculative growth. Well, since they're not going to get it on tech and some of these other institutions, you can, at least with biotech, these are stocks that could be considered growth, but they're not growth. You're not buying a biotech going, okay, I think we're going to get 30% revenue growth on this thing over for the next 6 quarters. You're buying this basically as a little bit of a basket of stocks, hoping you're going to get some new FDA approvals, that type of thing. It'll give you some surprise growth on that. So that's good. And then when you get the big healthcare, big pharmaceuticals and stuff, they still pay a nice dividend. And if growth is kind of cloudy in the other issues, you can at least have a nice steady growth in hospital stocks and pharmaceuticals, that type of thing. So again, these 4 sectors are defensive in nature, and they're the ones that are outperforming. Now pull up XLK, and this is your technology sector. Now, if you take a look at here, you go across this line here at 165. That's going to be kind of where we topped out back in early February twice. We didn't quite make it up to that here last week. It rolled over again. You can see we had some pretty good selling on Friday in that thing. So I think you're probably you want to keep an eye on that. If you things like the semiconductor ETFs, that type of thing, you might look to lighten up on these around 165 to see if they get to that. On the downside, I think you're probably looking at maybe 140, 145 or so. If you wanted to trade things in a range where you saw a couple of days where you saw technology stocks go down, if you took a look at XLK, you might pick up some semiconductor stocks or some high-tech stocks down there if this thing gets down to around 142, 145, and maybe you can ride it back up to that 165 area. Okay, the next one would be XLY. Let's take a look at that. And now this is another growth sector. This is consumer discretionary, and this is the one where people are going to be looking to, what I want to buy something. Okay, again, you have on this chart, you're going to have on the high side about 192 is where we got to last week early. It hit that. It was kind of looking good, but that it also represents where you kind of came down in last December. You kind of got down to that, so that previous support now becomes resistance. If you can see the XLY bust through that 192, maybe get up through 195, that would probably be a bell that would tell you that maybe the growth stocks would come back in. On the downside, I think you could, down here around 165, one maybe even higher than that, 167, somewhere in that, 168. That would be probably a spot where you could definitely load up on, say, like the Home Depots or the some of the other growth stocks like that, consumer discretionary. And that's I did notice that the some of the discount stores, the Family Dollar, Five Below, those stocks are actually outperforming some of your more basic retail stocks. So keep an eye on that. Another one to watch with this would be XRT, which is a you don't need to put it up, but that's the retail ETF, which will show you how the broad-based stocks are doing. Let's go ahead and take a look at XLI. I'm not going to go over all of them. We're almost done on this anyway, but okay, this would be the industrials. On this up here, I think right around 106, that area, which was a kind of got back in there last you're going all the way back last February or so, or a couple times, and then up around August, we got back up to that 106 area, went above it, and then end of October and the first of the year, we're getting up there again. Last week, we didn't quite get up to that. That would be a kind of a breakout place for the industrials. On the downside, I think you can look around here. If you could see this thing pull back down to around 90, 98 or so, you can draw a line across that, and you can see where that was support back last October. It was also support early February. It busted below there when we had the big dip in March, and it tried to hold it again just back here in March, several times. It played around that 98 area. So if you see the industrials come down around that, that would probably be a sign for you to watch to see if it bounced off that. That would give you another sign that the market is probably going to have another oversold bounce, and you could probably buy some stocks and jump in on that. And finally, I just wanted to mention the last two here real quick. XLB does look good. It's close to a new high. That's the materials, and of course, there's several reasons for that. I like this sector still because of the price in crude oil and natural gas, but also the commodities you're seeing. We've talked in the past about stocks like Vale, VALE, and the uranium, URA, and BHP. Some of these stocks that are mining stocks and all, they seem to be, they've done well. Another one we talked about last week, the EQNR, that was a Norwegian company that provides natural gas and crude oil for Europe. Guess what? Europe's cutting off all their oil and gas supplies from Russia. I think this Norwegian company certainly can provide as much as they can. They're already talking about their revenues could be up 100%. So that's one that it pays a decent dividend. But of course, these ADRs like that, they take some of your dividend away, so they're not quite as impressive as what they seem when you read the charts. And the last one would be XLF. Let's take a look at that, and then we'll wrap it up. Again, normally on a rising rate cycle, you're going to have you want to be in the banks. You want to own them. The rates are going up. The bank's going to make that spread between the short lows and the high lows. You get something like 2 to 4%. So they're picking up all the spread in there. In this case, you're starting to have an inverted yield curve, and then which is signaling possibly recession down the road. The banks aren't going to be the place you want to be. They're not going to make the money on the spreads, and if things are slowing down, then their loans are going to start to slow down also, which cuts into their profits. And I think in this case, until you would see a spread start to widen, you don't really want to own the banks. I don't think they're going to go anywhere. As you can see here, they're trading right now back basically where they were in about March or April of 2021. They've gone a little higher, come down a little bit. The peaks here we saw in January and again in the 1st of March, that was basically due to rates were supposed to go up and things were going great, and we had inflation, but we were going to tackle that by raising rates a little bit, and then with the war and everything, all the supply chain issues that's caused, again, it probably puts us into a recession later on within the year or so, and that's not going to be good for the banks either. So I don't see any reason to be buying those unless we see the end of this war thing over there. But anyway, to wrap it up, I think we're going to be range bound. Just too many headwinds going on right now, and we have the MarketEdge S&P short range oscillator that Jim Cramer, that's his go-to indicator in the market. I think you can keep a good eye on that when we get up there around over 6. We're probably looking at maybe a pullback on the market. You're probably getting to be at near the top of the trading range, and at the bottom we get down to a -6, -7. That seems to be the magic spot where we start to see buyers come in to bounce off of those low points. I would definitely keep track of that. I try to mention it once in a while in our weekly market letters and sometimes on the daily market letters. But that would be something you can watch. And until we break above these resistance areas that we just talked about today, you may want to just go back and forth with some of these, in these trading ranges. And if you want to trade them, that's fine. Otherwise, just kind of expect that to go. And if you're on margin at the bottoms, maybe you can ride margin up to the tops and then start to peel that off. But at some point when this war thing especially ends, you might see all these averages move up like maybe 1,000 points in the Dow. That may be a point if inflation's still going crazy. That'd be a good time to sell some of this stuff. But for right now, let's just kind of take in the thing. We'll kind of stay neutral and watch this market kind of go back and forth until we can see it break out one way or the other.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer on the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in. We'll see you next week.